All right, let's talk about what investors are saying then in reaction to this. Disney, as we talked about, posting second quarter revenue in line with the street's projections. Earnings revealing significant growth at the company's theme parks. Revenue for parks, experiences, and products coming in at $7.8 billion above estimates. And as we look on how the stock is trading in pre-market, it is down by nearly 6% on a decline in Disney Plus subscribers. For more on this, we turn to Doug Creutz, who's TD Cowen, Managing Director of TMT Media and Entertainment. Doug, I gotta admit, I'm surprised that the shares are down so much. And that's because, yes, subscribers fell, but the subscribers are more profitable. And it seems like maybe the company's on track or even ahead of profitability for streaming. Is that your view? And what do you think is going on here?
Yeah, I guess first I'd say it's not that they're more profitable, it's that they're less unprofitable. But I kind of agree. I'm surprised it's down this much. There wasn't that much in the report or the commentary by management that was surprising. We knew they were going to lose subs in the Hotstar regions, which are lower ARPU regions when they gave up the IPL rights. So that wasn't a major concern. I think there was some things that they talked about with the parks, that the sort of pricing rises that they've been able to get at the parks are slowing down. They've got tough comps against the Disney World 50th anniversary last year. They've got some cost pressure at the domestic parks. So that's been a really big margin story that seems to be at least in abeyance for a few quarters. I think also it's worth remembering that Iger signed on to be there for 2 years, and we're already 6 months into his tenure. He has to make changes fast. And I think, listening to last night, they're making changes, but it's sort of, the effects of those changes are still seem like they're a ways away. So there's progress, but it might be a little slow for some people.
Which means if we're 6 months into that, we're about a year off from getting a true picture of who might succeed him as well here. I mean,
in theory,
that is the strategy that gets put forward by most companies, especially when you have a boomerang CEO as Disney does. So is there anyone from your perspective that has a good kind of sense of how to continue to operate the streaming business, how to continue to make sure that, as they talked about the parks business on the call last night, that can continue to be a key growth driver for the company, that can kind of fuse together all of these different drivers and at the same time be looked at as the street as a leader that can be trusted even to navigate a difficult economic backdrop?
Yeah, it's a good question. I mean, there were people like Kevin Mayer who I think the street would have been fine with, but for one reason or another, they got passed over. He got passed over and left the company. Doesn't mean he couldn't come back, but it would be a little strange, I guess. Because of that, a lot of the people, Tom Staggs was another, Jay Rasulo was another that had a lot of experience at Disney, are gone. Have been gone for a while. Obviously, Bob Chapek, for various reasons, didn't work out. So that, do they have to go outside the company? That's tough, just because Disney has such a powerful culture, a dominating culture. To bring someone in from the outside, you never exactly know how good of a fit it's going to be. So, there's no sort of clear heir apparent yet. And they certainly haven't really elevated anybody in the last 6 months to make them look like the heir apparent. Again, it's a little early for that, but they've got to be thinking about it at least.
When we talk about the streaming business, Doug, and it seems like, as you wrote in your note, that we're going to get another price increase for the ad-free tier here. As a Disney Plus user and someone with kids in the household, I feel like it's a place we're going to more rarely these days because we've tapped out a lot of the content that we want to see. Are you confident in the slate of new stuff that's coming to that platform, or do they need this sort of Hulu, ESPN, Disney Plus offering to even just keep the momentum going?
Yeah, I think it's, to be totally blunt about their strategy, we're going to make the product worse and charge you more for it. And to be fair, that's the strategy of all the other streaming services right now, too. We're going to make less content. We're going to pull content off the service that was there, and we're going to raise price. They've been giving a lot of content away for too low of a price. That's why everyone's losing money. But if you're the consumer, it still doesn't feel particularly good. And I think, they didn't grow subs in their core markets last quarter. They basically said they're not going to do it again this quarter. They were more optimistic about the back end of the year when they say they have more content. then you sort of get down to, okay, how are their content sort of machines doing? You look at Lucasfilm and you look at Marvel, two really important ones. I think their output on the service has been a little mixed. There's been some very good shows. There's been some other shows that haven't worked. I would argue the stress of having to produce for Disney Plus has potentially affected their theatrical output as well. It's been 4 years, 3.5 years since the last Star Wars movie, and it's probably going to be another 3 years until we get the next one. Marvel had a rare miss with Ant-Man earlier this year. Guardians is doing well, but not as well as the last Guardians movie, even though arguably it's a better movie. So there may be some, I don't want to necessarily say customer fatigue for those franchises.
You can say customer
maybe
fatigue.
A little wariness about. Sorry?
I said you can say customer fatigue. Maybe.
Yeah, look, I don't believe in fatigue around genres or franchises as long as the quality of the product remains really high. People love great product, but I think the quality has been a little more hit or miss lately. So it's a tough needle to thread. I think bringing Hulu onto the platform, certainly it's a nice quality of life benefit for people who do subscribe to both products, not having to jump from one app to the other. Does it herald a point at which Hulu and Disney Plus totally get rolled in together domestically? Maybe, but then, what does that mean for all the money you spent acquiring Hulu in the first place, and the money you're going to have to continue to spend to buy in the last third from Comcast? So they've still got a tricky transition here to get from where they are now to getting to a point where the streaming services are really generating meaningful profit.
Doug, it wasn't until I unfortunately did the math on this before the show, but I haven't been to a Disney park in 20 years. Now, I hear the experience is vastly different than it was 2 decades ago, and it pains me to say that. But at the same time, that's great for Disney. It sounds like there's a lot of fanfare around the new experiences. This is also a key growth driver, as we mentioned earlier, for the business. What does Disney have to do to get parks right on a continued basis with all of the international expansion that they discussed on the call, and while they're still navigating, of course, some of the economic uncertainty in those different regions, where in some regions it's, okay, we finally turned the page from the COVID era and stricter policies, and in others it's, okay, well, consumers are also going to be monitoring how much they're spending into that experience even while they're there.
Yeah, I think, most of the discussion around Iger surrounds sort of the content side of the business. I think he probably doesn't get enough credit for what has done on the park side since he first took over, almost 20 years ago. Basically, their game plan has been, we're going to invest a lot of money in the parks. We're going to expand capacity. We're going to make the experience better for guests. More recently, they even moved into sort of it's a bit of a discriminatory pricing model where if you're willing to spend even more, you can get an even better experience. And as someone who has gone to the parks about once every decade in my life, I have a little bit of a mixed feeling about that, but it's certainly working well for them. They're going to continue to grow capacity across their whole parks footprint. They've got another cruise line coming out. They're expanding, the Shanghai park. There are other international parks. They're going to continue to invest in the domestic parks. The Marvel's Avenger campus has been a big hit. So, it's just continuing to invest, continue to make it a great experience, a premium experience, and then, making sure the guest experience is really positive.
Of course, Bob Iger was asked about AI because everybody is being asked about AI. We just want to listen to what he had to say on the call when he was asked about it.
I'm looking forward to a time where maybe AI does earnings calls for me. And you wouldn't know the difference, perhaps. Maybe they'd be better. I don't know.
So he joked about it at first, right? But then he did talk about the potential as well as the risks for it, right? But he talked about it in sort of vague terms. It didn't seem like it's something that the company is concretely working deeply on right now. Do they need to be? Is there a big potential there for them? It seems like everybody is talking about it right now.
Yeah, I think, one of Bob's strengths is that he has pretty good relationships with the creative community. And if you mention the word AI to creatives, they freak out because they're like, you're coming after my job. I think Bob's smart enough to understand that AI isn't going to replace creatives. They're making human products for human beings. That said, I think there's areas where AI can certainly help the creative process. And so I think, he understands it's a tool that they're going to want to engage with, but he's going to want to be very careful about how much he sort of touts that because, he doesn't want his key people who are creating all this great content to feel like they're going to be devalued.
Yeah, no, that's a great point. I mean, well, we'll see if, as the analyst had asked on the call too, or at least mentioned in commentary, if analysts start to just have their own AI bot chime into the call and ask the questions after they've been able to kind of ingest the earnings report as well. Doug, thanks so much for taking the time here on the day. TD Cowen's Doug Creutz. We appreciate it.
Thank you.